Hello, Matthew Bell with InsurancePrescription.com, and today I wanted to talk about negative interest rates. I'm not really going to call this an introduction so much as simply an alert or a bulletin to just kind of make you aware of the fact that negative interest rates are a possibility if you weren't already aware of it. So most people are aware that interest rates right now are at rock bottom. That is to say, if you have money in a certificate of deposit, in a money market, in a savings account, you're basically making nothing whatsoever on that money. And this is a function of the fact that the Federal Reserve has set the federal funds rate to basically zero. Federal funds rate is the rate at which banks lend money to one another, and it's determined by the Federal Reserve, essentially. And so the Federal Reserve actually has a range of 0% to 0.25, but for all intents and purposes, it's 0%, and that's the way the media has been reporting it, is that interest rates are zero. But obviously, they have been falling for some time, and after zero, the only place they can fall to is in the negative territory. Not too long ago, this was conceived of as an impossibility. It's not in a lot of economics textbooks and this kind of thing, but there are real reasons to think that it is a possibility. So the first reason is that President Trump has actually asked the Federal Reserve to do this, to put interest rates into the negative. The second reason to think that it's a possibility is that other countries have actually done it. Denmark, for example, has done it. Japan has done it. But the third reason to think that it's a possibility not just in the abstract or in Europe or in Asia, but it's a possibility for here, is that futures contracts, which basically predict or are bets on which direction prices and different rates are going to go, futures contracts have actually already started to show the possibility of negative interest rates. And we're talking in a couple of months, next year, at the beginning of the year. The futures contracts are highly variable and they change, but the futures contracts are starting to indicate that some investors believe negative interest rates to be a real possibility. Why are interest rates potentially negative? What would be the point of it? Well, the point of it essentially is to avoid deflation. And deflation is basically a circumstance in which either there's a shortage of money and prices start to fall. And when there are falling prices, what essentially happens is people don't spend, because the psychology behind it is that I might say, well, why would I buy a house today when it's going to be cheaper tomorrow? Why would I buy a car today when it's going to be cheaper tomorrow? Simply because prices are falling. So spending grinds to a halt. Unemployment can go up on account of deflation, and you can enter in what's sometimes referred to as a deflationary spiral. And this is bad. According to standard theory, obviously, this is going to result in a recession, in a depression even, and can be extraordinarily bad. So the Federal Reserve wants to avoid this at all costs. But on the other hand, they don't want to cause hyperinflation. They don't want prices to go through the roof. What they want is to try and keep inflation at some, what they refer to as a manageable rate. Usually it's reported to be between 2 and 4%. Now, what would happen if they actually put rates into the negative? And the answer is, we're not entirely sure. This is something that basically departs from the textbooks. It departs from some of the standard theory on interest rates and the like of this. We can say that in places where it has happened, we can see some of what has occurred. So, for instance, in Japan, banks started to charge people money for deposits, and so people started to pull their money out. Because you think about it, if there is a positive interest rate, then banks are paying you to keep your money on deposit with them. But as the rates fall, you get paid less and less until they cross into negative territory, where in theory you would start paying the bank to hold your money. And similar things could be said for things like treasuries. So you might buy government treasuries and they pay you a certain interest rate, but the rate has gotten less and less until it goes negative, and then you pay the government to actually keep your money in a treasury. Now, a related possibility is that lenders would then start to pay you money to borrow money from them. Now, this is a possibility in the abstract, and it goes along with the possibility that you would have to pay money to depository institutions to hold your money. But in this case, the possibility seems a little bit even more remote, and there's a number of reasons for that. The first reason is that in an environment where interest rates are negative, there could be other pressures that prevent lenders from even wanting to lend money out at all. And one of those would be rampant unemployment. So 20 million people, 30 million people have just filed for unemployment over the last couple of months, and those have ratcheted up the unemployment numbers. Well, in those circumstances, lenders are not going to consider those people to be borrowers that they want to lend money to, because they're highly risky. Another factor is that lenders often are going to tack on charges and other fees, premiums over the top of the actual rate of interest, and that can essentially nullify any benefit that the borrower might get from negative interest rates. So it always seems to happen that the big institutions benefit from this in a way that the little person does not benefit from it. So you might start having to pay a bank to keep your money on deposit, but at the same time, the negative interest rates won't benefit you as a borrower because they might view you as too risky to lend to, or because they might tack additional fees on so that they can cancel out any money that they might have to give to you to borrow money. But you have to realize the very tenuous nature of all of this, the very uncertain times that we're in. So it is the case that we're not sure that interest rates are going to go negative. There are several indicators that they might, and you should at least start thinking through it. Part of the conversation is going to be about whether or not we go into this deflationary spiral, which they're trying to avoid, whether we have inflation, whether we have hyperinflation. You'll hear the word stagflation thrown out in this scenario. And a lot of this is uncertain, partly because older models for how to understand the economy are thought now to be less and less relevant. So once upon a time, it was the case that they thought that the amount of money in circulation was directly related to prices, so that if you increase the amount of money in circulation, you would cause an increase in prices. In other words, monetary inflation leads to price inflation. But many people challenge this because it has partly to do with something called the velocity of money, which is the rate at which money changes hands from person to person, institution to institution, and the velocity of money has gone way down. So even though the Federal Reserve is pumping trillions of new dollars into the system, the thinking goes, because the velocity of money has slowed way down, that additional quantitative easing or introduction of money into the system won't predictably have the effect of raising prices. In fact, we're seeing deflation. But there's a lot of manipulation, I think, that goes on in terms of some of these numbers. It's unclear in what direction we're actually going to take off. Now, what can you do? Well, that is a little bit of a guesswork as well. The thing that I would at least start to encourage you to think about is, what would you do if you have money in savings account and the bank started to charge you money? Now, is it for sure that they will? Absolutely not. The interest rates might not go negative. In some places, like in Denmark, people who had deposits under a certain threshold, the banks did not charge those people to hold their deposits. It just applied to people who had money over a certain amount, let's say $1 million. So it's not clear what the results of this are going to be, but I think it would at least be good to start thinking through, what would you do in the event that your money in savings, that your money in a money market, the bank started to charge you to keep it? Would you move it? Where could you move it? Some people suggest Bitcoin, another cryptocurrency. Some people suggest gold. Some people suggest insurance company instruments with guaranteed rates. Some people would suggest real estate or other kinds of real property. This video is for general informational or entertainment purposes only. My ambition is simply to sort of get you to think through some of the issues, and I know this isn't a real happy conversation, but this is a potential, and I don't want you to be caught unawares if and when this actually occurs. So if you found something of use in the video, I ask that you like it, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video. Thank you.